Well, hi and welcome. My name is Casey Boland. I'm a wealth advisor and partner with HCM Wealth Advisors. And I'm joined today by Doug Johnson, who's our senior investment strategist and partner with HCM Wealth Advisors. Welcome to our webinar. Now, if you'd like to ask a question, please go to the bottom of your screen and click on Q&A, and there you'll have an opportunity to submit your question. And we'll do our best to answer at the end of the webinar. So Doug, it's summertime. You expect the temperatures to be hot, but wow, it was over 100 degrees in London. In Ireland and some other countries in Europe, they're experiencing surprisingly hot temperatures. Now on the economic front, surprisingly hot. Well, that's not a term that you're wanting to hear when we're referring to the consumer price index. And that was reported last week for the month of June. And surprisingly hot, it was already surprisingly hot in May. So we had 2 months in a row of hot reports. In June, the CPI jumped 1.3% month over month. It was driven by a surge in energy prices. CPI was up 9.1% on an annual basis, which is the biggest jump since November 1981. So when you look at the slide, you can see energy in the green bars, food in the yellow, they were up 42% and 10% respectively. Now, even excluding food and energy prices, core CPI accelerated with services, which are represented in the blue on the graph. They continued at a hotter than expected pace. So, bottom line, inflation right now, it's really a lot more than just volatile food and energy prices. Prices for most everything is inflating. And with this bad CPI report, one might expect that the market would sell off based on this surprise. Well, surprise, the stock market has actually moved up. A few of the days, the last couple of days, they've been some of the strongest broad-based moves up in the stock market in quite some time. So let's put some context in this recent move, though. We're not saying that the bear market is over and the market bottom is behind us. We're not saying that.
Casey, I think you need to repeat that like 6 times.
We're not saying the bottom's behind us. We still have a long way to go in this process.
It could be.
It could be. But historically speaking, some of the moves we've seen in the market here oftentimes have been the early signs of kind of the new beginnings of a bull market. Now, we're not jumping that far into the process and saying, hey, the bear is over, the bull's here, but we can start to build on this. And again, we're going to need to have more positive evidence that is needed to see that the trend is reversed. And that's going to take time. And I still think it's still going to take many months, though, for this to play out, because the Fed, though, they've got inflation locked in their crosshairs, and they're going to be looking for clear and convincing evidence that inflation's coming down. Because back in March, it seemed like you had the high in CPI, but then it dipped, it dipped in April, which proved to be a head fake. So the Fed remembers this, and it's reasonable to assume that the Fed's going to want more than 1 month of data on cooling prices before it's going to declare any type of victory on inflation. So, but, we're going to look at a lot of different slides and things that track whether things are good news, the bad news. Sometimes good news can be bad news can be good news. So one we're looking at here has to do with wage growth. And when you take a look at economic data like this, you look at it under a microscope and you're trying to see then in the context of inflation. So do we want to understand if inflation is going to continue to increase? Is it going to be persistently high, or is it going to slow? So it's challenging. So when we take a look at this particular slide, you've got strong wage growth, which on one hand, somebody could look and say that's positive, but strong wage growth contributes to inflation. So whether something is good or bad, we're going to look at some more slides in the context of what the Fed's thinking about inflation. So wage growth appears to be negative on the inflation front. But if we move on, let's look at now, we're going to look at unemployment claims. So unemployment, those are timely. We get that piece of information weekly. And this morning, as a matter of fact, we had a signal from the labor market that unemployment claims, they climbed again. They're above 250,000, which is the highest weekly level since mid-November. Now, if you look at the chart, you look at the bottom right there where that red trend is, it's starting to move up, and it's well below what you would normally see with recessionary levels. But when you look at the trend, though, I mean, the trend, obviously, this is unwelcome news for job seekers. But when you look at the trend, that's the concern, that the trend is starting to increase. However, a cooling labor market, though, should help ease wage growth, which is a slide that we just viewed before. This, in turn, could cause inflation to come down. So this is something the Fed is explicitly aiming for. In other words, bad news in the labor market may be good news regarding inflation. I know that's not good for jobs, but in the context of inflation right now, that's what the Fed's looking at. So what are other signs that inflation may be peaking? So if we look at our next slide, we're going to see that the average price for shipping containers is coming down. Supply chain disruptions have been a driver of inflation. So improvements in this area, that's a welcome sign. Supply chain improvements, it may not be the only driver of this decline. It could be a decrease in purchasing by businesses, as we've seen and heard about reports of building inventory, or it might be the shift in consumer spending that's moved from goods to services. Regardless of the drivers, though, it's a welcome sign, though, on the inflation front. Then we look at commodities. So commodity prices, we've seen it at the gas pump. Gas prices have finally started to come down here in recent weeks. Commodity prices across the board have been coming down. So good news on the inflation front. Now, some are concerned that the drop in commodity prices, it's tied to worries about recession. Recession would mean weaker demand for commodities, hence the concern relating to the prices dropping. But right now, I think at this point in time, it's going to be a welcome sign that you're seeing many commodity prices drop. They need to drop. The Fed is looking for drops in inflation. This is going to be a driver of that. So we'll see if that can be, those energy prices can stay and be sustained at these levels and stay down. And that certainly could have an impact on inflation, but it's going to take time for us to understand this and for it to play itself out. So Doug, let's switch gears a bit away from inflation and let's look at some other factors.
Okay. So, kind of as Casey said, switching gears a little bit, obviously we've spent a lot of time talking about inflation, not only at the beginning of this presentation, but I would say the last 5 or 6 webinars that we've done, I want to say that's been kind of the main topic. And, before, I think it was more related to, how that's going to affect the market. And it certainly has. But now we're getting into this, what you'd call transition from concerns about inflation to concerns about recession. So, one kind of underlying theme that I would lay out for the entire presentation here is kind of this undertone of, are these things that we're talking about now going to lead us into a recession at some point? And, the reason that's so important is because historically, when you've seen bear markets, which we're technically still in a bear market right now, that have been accompanied by recessions, the bear market is deeper and it is longer than those that are not accompanied by recession. So, that I think is kind of one of the main themes to take away from this is this ongoing question of, are we going into a recession or are we not going into a recession? So, one of the big drivers of that obviously is employment, but corporate earnings. Usually during recessions, earnings growth slows at best and actually contracts at worst. So right now you're starting to see the beginning of second quarter earnings season for companies. And I would say the results so far have been somewhat mixed. But one of the constant issues that is coming up in a lot of these calls is this idea of currency adjustments. So when we talk about the dollar in terms of strength, there's an index called the DXY. You might have heard it referred to as the Dixie before. So it tracks the dollar versus several other currencies around the world. But the euro and the yen make up, I think, 75% of that basket. So if you look at what the dollar has done to both the euro and the yen over the past, I'd say, year and a half, it's pretty remarkable to see this move. So it's been in the news. The euro and the dollar hit parity I want to say it was late last week, but that's the first time that we've seen that since 2002. And then on the yen, you've got the lowest yen to dollar ratio here since 1998. So what that means is for companies that drive a significant amount of revenue outside the United States, when they repatriate that money and have to run that through their earnings, they have to convert it back into dollars. So if you have a company that's selling a significant amount of their products in euros, and then they have to convert it back to the dollar, they're losing money on that conversion. And at the levels they're doing it now, that's been a big headwind. So that's one of the main things that I think you're going to hear a lot about on these earnings calls, is this idea of, well, here were our results, but based on a constant currency, meaning we're just going to ignore this, things weren't as bad. So we've talked a lot about valuations in the past, and a lot of people are asking right now, what is fair value, or what is a reasonable valuation for the marketplace? I think it's safe to say that about a year and a half ago, valuations were at extreme levels across the board. I mean, you could look at basically any metric that you wanted to and say, okay, this is probably in the top, 1 to 2% of all observations in history. So normally when you're starting from those levels, the future doesn't look great. So if we look at where we've come to now, we've seen these valuations come down quite a bit on a price to earnings ratio. And if we look at it in a few different metrics, this top bar represents the 1 year forward price to earnings. So forward price to earnings is going to use earnings expectations, not what's actually happened, but what analysts think is going to happen going forward, and then using the current price in the S&P 500. So, to compare it to some other, historical timeframes where you've had high valuations, here in 2000, when you had the tech bubble, valuations came down initially to about, the 40-year average. So they don't need to necessarily collapse, so to speak. And here we're still a little bit above that 40-year average, but we've come down quite a ways. If you use the trailing operating earnings for the last 4 quarters, so this is numbers that have actually taken place, you're actually under the mean right now, and we've come from over 30 down to about 16 or 17. That's a really big move on a percentage basis. And then lastly, GAAP earnings, which is just kind of another way to state earnings that have actually been reported. Again, that number has peaked, and now that PE ratio has come down below the mean. So, from a valuation standpoint, we look at that and say, okay, have multiples adjusted enough to make us feel like things are, in line to get better, so to speak. And one interesting observation here is when you look at earnings versus valuations, and this chart goes back to 1996, what you can see is that some of the major drawdowns that we had in markets basically started when you saw a peak in earnings per share growth, but some of them didn't. So we've got one here in 2000. Then you had, a peak in earnings growth in 2004 that didn't really result in anything. But then look here in 2010, you had a peak in earnings growth, a significant peak in earnings growth, which happened after the great financial crisis and resulted in this massive bull market that lasted almost a decade. Now, here we are again, peak in earnings per share growth is almost, certainly happening, or has happened back in January, and we're now on the downside of that. So the question is, how steep is this decline going to be? The expectation is that we're going to get 10% earnings growth this year, which is, if we do, we're probably close to, what I would say would be a reasonable expectation of fair value. However, if this, we'll call it aqua color or teal color, goes below zero and you actually see earnings contraction, which again, in a recessionary period is kind of the norm, then, there could be some more volatility ahead. But as we looked at P's earlier, I think one interesting thing to point out about these charts is that in the past, when we've seen kind of bottoms in the market, it's also been the trough in contraction for PE ratios. So the PEs are these purple bars here. So the bottom in the 2000 market, you had a 28% contraction in PEs. Bottom in the great financial crisis, 30% contraction in PEs. 2018, when you had roughly 20% sell off in the market, you had a 24% contraction. Right now, we're at about 29%. So if you want to go off a percentage basis, we've kind of reached that historical level where things slowly start to get better. Doesn't mean that it has to be this way, but looking at valuations from a different lens, so to speak, this I think offers some level of optimism in terms of what things are going to look like going forward. So, we've talked about this idea of recession versus no recession, and the technical definition of a recession is 2 consecutive quarters of negative GDP growth. We've already had 1 negative quarter in the first quarter, and now here is the Atlanta Fed's GDP now estimate for the second quarter, and it's gone from a little bit over 2% in the middle of May, and the forecast has now dropped all the way to negative 1.5. So what does that mean? Obviously that, it's still just a forecast, but the expectation is for, the possibility that we see negative GDP growth in the second quarter, which again would technically put us into a recession. But I think there's a lot of things that go along with that than just having a quote unquote, two consecutive negative quarters of GDP growth. Usually the worst recessions are accompanied by significant stress in the employment market, which we haven't really seen that yet. The unemployment rate remains fairly low. Job growth remains, we'll call it robust for now, but that'll be an important aspect of where this economic growth goes going forward. Because at the same time, the Fed has never gone through a rate hike cycle into a recession. It's never happened. So you've heard a lot of talk about, will the Fed eventually pivot off of raising rates, and how is that going to affect the market overall? Well, yes, they want to fight inflation, but if they're going to create a massive recession in the process, they may take another look at this and say, you know what, we'll live with a little bit more or a little bit more inflation than we had in the past, if it means that we're not going to go through a severe contraction in economic growth. And as we've seen some of these, bad economic numbers coming out and some of these GDP forecasts, we've had bond yields leveling off a little bit. So, bonds have been a big topic this year, obviously with very large negative returns, but a lot of that has happened in a very condensed time frame. And you can see here the yield spike that started in kind of the tail end of April, all the way up to the 10-year Treasury getting to around 3.5. Those things, the bond yields are driven, at least in the longer end, on expectations of economic growth. And if there's a strong sense that we're going into a recession or even a growth slowdown, it's hard for the longer end of the bond market to then accelerate yields even higher, because it's going to be offset by that leveling off, so to speak, in economic growth. And you can see it even here on the 2-year Treasury, which relates more to what the Fed is ultimately going to do in terms of raising rates. And that is, level, we'll call it leveling off. But if we look at the peak, it's actually come back down a little bit, along with the market's expectation of what inflation is going to be going forward, which again, if you look at it, we have CPI at 9% right now. The market pricing for 5-year inflation is still at 2.1. So something has to give at some point. Either this is going to have to go up, or that CPI is going to come down. Could be a combination of both, but it'll be interesting to see what that looks like going forward. One other kind of interesting, or we'll call it a buzz topic that you hear in the news, is this idea of yield curve inversions, and how yield curve inversions always precede recession. One of the most popular yield curves is the 2-year, 10-year spread on the US Treasury. So as of right now, that spread is negative 22 basis points. So it is currently inverted, and it was actually inverted several months ago as well. So, interesting tidbit. You've never had a yield curve. You've never had the 2-10 spread invert 2 separate times in a short period of time, at least, before a recession. So there's several yield curves that people pay attention to. There's the 2-10, obviously, the 2-30-year, 10-30-year, the 3-month. I mean, you can put together whatever combination you want. And this chart shows how many of those yield spreads are actually inverted right now. And you can see as the number spikes, you see the gray bars, and the gray bars denote a recession. So every time that you've seen recession come, you've had this number, north of 70, and most of the time getting close to 90. Where are we right now? We're still at about 45. So while you've got a fair amount signaling economic turmoil ahead, you're still not at the level historically that you've seen that has been, the precursor to recession, so to speak. Now, one thing that, this is more of a tongue-in-cheek chart, I would say, but you can see in the past when most people say a recession is now likely, it's marked the bottom of the market, so to speak. So you've got March 2009, which is the end of the great financial crisis. And this to me is comical, because I'm not sure how this wasn't at 100% for months during what was going on at that time. I'm not sure how this never got to 100% during the great financial crisis. But nonetheless, when it peaked, you had the bottom of the market. Same thing during COVID. When this peaked, you had the bottom of the market. Now, I don't know if this is peaking yet, but it has certainly come from a very low level. And as we pay attention to this, from a bad news is good news scenario, if you have a significant amount of people saying recession is likely here, it could mean that we're further along in this pain process than we think. So certainly an interesting chart here that, granted, it only goes back to 2006, but I thought it was interesting that these peaks absolutely nailed the bottom of 2 of the most significant drawdowns that we've seen over the past 20 years. So, when we talk about sentiment and, maybe some of the things that can be indicators that, intuitively you wouldn't think would be, because Casey, would you agree with me? There's an awful lot of negativity going on right now in the markets. Now, granted, some of it is very deserved, but it's normally in those environments that sometimes these unexpected reversals can be born. Would you agree with that?
I would agree. I think there's probably a lot in the camp that may look and say, hey, this is a bear market rally. And whether it's on the investing front, on the consumer front, on the consumer sentiment, it seems like survey after survey after survey, you're getting close to extreme levels of pessimism.
Yeah, and this is, this chart's a perfect example. So this is a chart that was generated by Ned Davis Research, and it essentially shows the sentiment of investors. It's called a crowd poll, basically. And the way that they look at this is it's a very contrarian chart. So when they see extreme pessimism, and again, this chart in this version only goes back to 2016, but they take the entire data set back to 1995. And what you can see is that the returns for the S&P 500 on an annualized basis are significantly higher when sentiment is worse than when it's good. So you've got extremely negative sentiment, obviously, around the COVID crisis. You had negative sentiment around the 20% drawdown that we saw during the first attempt by the Fed to raise rates. And now you've got, sentiment that's close, if not, right on the levels that we've seen at some of the worst points over the past 5 years. So again, as Casey mentioned earlier, and we, if we had time, we'd repeat 6 times, but we're not saying that this market has seen the bottom. Could it? Absolutely. But it's not a certainty. But these are the things right now that we're looking at from a sentiment standpoint, saying, okay, this is some light in a very kind of dark time, I think is the best way to put it. And then, in terms of positioning, so this is the aggregate equity futures positioning for asset managers and leverage funds. So this is basically a asset managers plus, we'll call them hedge funds. And this is their positioning right now in the marketplace. And it is a negative, on the whole, the easiest way to look at this is to say they're, for the most part, asset managers and hedge funds are short right now in the market. They're openly betting for things to get worse. And again, usually when that takes place, it sets the table for, the opportunity for things to turn around in a very, very quick way. So, one of the topics that we sent out in the invite was kind of a market psychology. It was expectations versus reality. So, as we look at these charts, the expectations are about as bad as they can get. So what has the reality been in the past when things look like this? And I think, people would be surprised that most of these turnarounds happen, I don't want to say out of nowhere, but they happen when people think that they can't happen. And again, here's another one. So this is U.S. small business consumer sentiment. So, this goes back to 1978. So this is a very, very robust data set here. But when small businesses are at their most pessimistic, again, you're seeing levels where markets bottom. So again, March 2009, almost equal with right now, April 20, October 90, April 80. So again, it just goes along with the theme that there is so much negativity out there right now that I'm not sure there can be more negativity. I mean, I guess based on this chart, there could be. But the question remains is, have we seen the worst of things? And are people too negative right now? I mean, cash levels, same story. So cash levels right now are currently at the highest they've been since back in the tech wreck. They weren't even this high in the great financial crisis. So, people have stacked cash, and we ourselves have raised cash in our tactical models back in February and just recently redeployed that. So the idea that raising cash is a bad idea, I think we've shown that that's certainly not the case. But a lot of people out there have raised a significant amount of cash in anticipation of things, quote unquote, getting worse. But again, these are all at levels where things had historically gotten a little bit better from that point. Now, Casey talked about inflation at the beginning of the presentation, and why is inflation so important, or at least in terms of finding the peak of inflation. And this chart, I think, does a good job of showing why. So this goes back, I think, to 1960, and what it does is this is kind of the inflation peak line right here. And then this is the S&P 500, and there's different bands representing different scenarios. So this is scaled to 100. So what you see is on average, 9 months to the inflation peak, you get a drawdown of roughly 10 to 15% in the S&P, which is kind of what we've seen, maybe a little bit more than that. But then once you reach that inflation peak, things kind of turn around. Again, this is going from 100. So you're looking at, over the next 12 months, some good gains on average. And really the situation that's the worst here, and when we looked at this, we found this interesting, is when you take out the 70s, which was the longest period of inflation that we've had, which, I mean, honestly, I would have thought brought this down, would bring these lines down, but in fact, does the exact opposite. So, and even then, 12 months later, you had a positive market, even though you went through an additional 10% drawdown there. So I think when we can start to sniff out that peak in inflation, and as Casey mentioned before, you've had commodity prices rolling over, and in some instances, pretty hard. And the latest CPI data that we've had is about 15 to 40 days, we'll call it in arrears. So that next reading, a lot of those commodity prices will have come down. Now, will it be enough to put a dent in the number? That kind of remains to be seen, so to speak.
Yeah, Doug. So when you take all the evidence and all the data, certainly it's people are in dire straits, sour mood. And let's see what the pain has been in the stock market. I mean, we've experienced a pretty great deal of pain. You look at the stock indices, the S&P 500 and the Russell 2000. When you look at the left side of this chart, they year to date, they've been down around 25%. The NASDAQ's been off 33%. And when you dig into the numbers a bit more, you can see that the average stock drawdown is actually much worse. The major stock indices tend to be skewed by the larger companies as they receive a larger weighting in the index. And so it tends to skew those numbers. And when you extend the time period just a little further and you go into last year, you can see that the average stock in some areas of the market was down almost 50%. So we've certainly experienced a substantial amount of pain already in the market. And when we now start to include bonds into the mix, unfortunately, bonds just have not provided the solace they normally do when you've got stock market volatility. As you can see, this has been the worst year for bonds in more than 40 years. So, we keep talking about it is the worst behind us. Now, economic data wise and earnings, the answer is probably no. The worst is not likely behind us. Now, what about stock market? Now, remember, the stock market is a discount mechanism, meaning that it trades on future expectations. So Doug was talking about earnings earlier. It falls, the stock market falls before earnings growth turns lower, and it rallies before the economy emerges from recessions, and it bottoms before an official Fed announcement of a dovish policy. So historically, some of the biggest moves in the stock market happen before the all clear sign. So we shouldn't be surprised to learn in hindsight that the stock market began its sustained rally before we got confirmation that inflation was indisputably trending lower, and a signal from the Fed that it may soon be time to ease up on monetary policy. Now, that's going to be a while. Historically, though, some of those big moves come before that point. Now, are we saying again, if we hit the market bottom? No. I wish that I could say that was the answer. This is going to take time to play itself out. But as an investor, though, it's important to remember that some of the biggest moves come when the data goes from ugly to bad. And you need to be invested to capture those returns when that time comes around.
So
go ahead, Doug.
Oh, I'm sorry. Yeah. So one of the main themes that we've talked about over the past, I'd say 2 years, is this growth versus value trade. And for, I'd say, a majority of the time, we have been kind of, I don't want to say pounding the table, because I think that's a little bit, too aggressive a term. But we've certainly, shared our view that we think that that the environment was ripe for value to outperform growth. And the good news is we've certainly seen that for the most part. So this chart shows the Russell 1000 growth versus the Russell 1000 value. So when this line is trending up, it means that the Russell 1000 growth is outperforming the Russell 1000 value. So coming out of COVID, obviously growth, certain areas of the market, particularly growth, really outperformed value in a significant way. Then you had the election, and rates starting to move up, inflation starting to tick up, value started to make a comeback, a little bit of growth. And then when inflation really hit its ramp point, value significantly outperformed growth over these past few months. Now, just recently, we've seen that leadership change again. And as we kind of take a look at the landscape and say, okay, does this make sense that this is happening? I think in some instances it could make sense, because you want to own growth stocks in an environment that's going to have low economic growth, because historically they've been able to generate earnings growth irrespective of what the economic cycle looks like. Um, and as we've seen expectations for slowing economic growth coming out, that is not the best environment for cyclical value. In addition, if we see inflation starting to move lower, and we see rates starting to move back down, again, that would take away some of the kind of tailwinds that we've seen in that value versus growth relationship. So, some of you may have noticed that when we added some of the cash back in the tactical portfolios, that money was added to growth. It was added to broad market index, which leans a little growth, and it was also added to small cap. So 3 areas that we'd kind of, I don't want to say stayed away from, but underweighted through, the most part of the cycle. But now I think you're starting to see a setup where growth could start to take leadership again if the conditions that we're seeing right now do come to fruition. And when you look at the returns over the past month, I think that, it bears itself out a little bit. So, obviously we've had a good rally here. That's, when I checked right before I hopped on, it looks like it's continuing today. So that's a good sign. But if you look at the returns for these factors, so growth, 11.25%, you've got small cap at 9.8, you've got the S&P at 8.2, and then you've got value down here at 6.5. So we're starting to see that leadership changing a little bit. And you're starting to see a little bit of outperformance coming from some of the areas of the market that have been hit the hardest. And again, with the economic backdrop that we've seen, it's not really a surprise that that's taking place. Now, the $1 million question is, how sustainable is that? And I think, as we get through earnings season, we're definitely going to find that out.
So the HCM case, the Fed remains committed to fighting inflation, though expectations for a lower terminal rate may have become more widespread. And the Fed will likely keep the pedal on the metal on inflation until it sees a clear sign that they're making headwind on that front. In markets, it's been great to see they've shown some resiliency as concerns about a recession they're mixed with hope around peak inflation. We're starting to see maybe some anecdotes of evidence there. But again, I think it's going to take time, and that still may take several months to play itself out. The bond market, as Doug mentioned, maybe starting to signal a transition from inflation being the biggest concern now to recession being the biggest concern. And earnings, they are expected to cool off. The question is how much. It's going to be an important quarter, both on what the numbers are, what the outlook is, and what has the market factored in. So far, the reports have been decent at this point in time. The markets have been digesting that, but there's an awful lot of earnings reports still to come. In the current rally, it's showing some signs of sustainability, but it's we need a little bit more proof, and confirmations can be needed, and that's going to still take some time.
Yeah, and to that point, I mean, I think a lot of people have asked, what might that confirmation look like? We've talked about this idea of breadth thrusts before, and basically what those are is, and there's a number of different ones that you can look at, but it shows that the market moves are broad-based and they have strength. So, as we look at all of these, indicators that would, lead us to make these decisions, we're starting to see some that are signaling that haven't signaled for quite a while. In fact, we had one signal, with the move on Monday that hasn't fired since the day after the COVID bottom, which was, roughly 2 years ago. So I think if we can see a few of these, kind of build on each other, it would certainly be a reassuring sign that this could have some legs. Now, with that, we also, looked at kind of the historical precedent for some of these, and Casey, I think you and I were both surprised that, some of these did not fire during, some significant bear market rallies in both 2000 and 2008. So they didn't, take the bait, so to speak. But I think going forward for us, and that kind of, ties into this next slide here, we've moved our equity positioning back to neutral in our tactical models. And that was, in response to seeing some pretty extreme oversold levels in several of the major indexes. Now, whether or not that becomes a permanent position or it becomes more of a trading position, I think is yet to be seen. But what I would say is, so far so good on that. We maintain a slight value bias, but we've recently added to growth into small cap, which I mentioned earlier. And I think a lot of that has to do with that the slower economic growth and reduced inflation expectations that have come through have affected that leadership, but they've also reversed yields off some of their peak levels, which I think is a good sign. I'm not sure that the economy or the market could handle 10-year treasury rates at 4, 4.5, or 5%. So it's good to see that kind of peaking out around 3 right now. And then really earnings, inflation, and employment are going to remain the key factors in determining the actions of the Fed, along with the fight against recession. So if earnings can maintain themselves, if inflation can start to move back down and employment stays, somewhat in line, the worst of this could be over. And I know a lot of people, kind of maybe can't believe that, but that's the reality. Now, at the same time, if earnings fall apart, inflation stays high, and we start to see unemployment tick up, then this could just be the eye of the hurricane, so to speak. So a lot's going to depend on the next few weeks for sure. And then this quote, which I think is pretty timely right now. It's the mark of an educated mind. I included the word investor there for full disclosure, to be able to entertain a thought without accepting it. So that's a quote from Aristotle, but I think it fits well to this market where, things might seem obvious with everything in front of us, but a lot of times you just have to be very open-minded in the past that these things can move in, and not be quote unquote locked in to one scenario, and not be nimble enough to take advantage of some of these moves that we're seeing. So let me just check here the Q&A real quick. So it looks like we have a question here about cryptocurrencies, which is always a hot topic, mainly centered around the fact that we've seen prices of the main cryptocurrencies drop significantly. Does this present an opportunity for that sector? Casey, I'll let you go first before I have my standard answer for this.
Well, this is going to be similar to it, predicting whether this is the bottom. I don't know, and it's a very difficult question to answer. Certainly, crypto has fallen off quite a bit, but crypto, I think, has proven that it's not necessarily a hedge against market volatility, and it's not been a hedge against inflation. And I think that's what some people thought that would be the case, and it's not been. It's an asset class, and it's an asset class that, just like stocks in other areas, it can be volatile, and it's been extremely volatile, and it's come down quite a bit. Could it present an opportunity? It certainly may. I think a risk down the road, longer term, is to what degree at some point do you have the government step in and have more rules and regulation that comes into play? And I think that could be a little bit challenging for crypto down the road, but I don't have enough of an opinion on the area. And a lot of people that I follow that I think are pretty smart and know a lot about it, even most of them seem to admit that they're not really sure where it's headed as well. So I hate to not be able to provide an answer, but at the same time, I don't want to provide an answer to something that I really don't have enough knowledge about.
Well, I think you provided an answer. I mean, the original thesis, if you're talking about a fundamental thesis, and you don't have to necessarily have a fundamental thesis to buy into something, but that's, we try to think about things on a fundamental basis. And the idea originally was that it was a hedge against inflation, a hedge of the death of the dollar, a hedge against all of these things, and it's been a hedge against absolutely nothing. So I think investors need to be honest with themselves and say, am I buying this because I'm trying to diversify my portfolio against these risks? Or am I really buying this because I have a dream that this is going to go from 30 to 100,000?
And, and to that level, if somebody wants to invest in it, but do so at a very small dose, I mean, it's like diversification. If you concentrate in too much and you take a bullet, you're likely it could be the death shot. Diversification is the Kevlar best. And so that's why you do it. And here, if you want to have a little exposure, make it a very small level that it won't change your financial circumstances in a negative way if things don't go the right way.
I would agree with that 100%. So that's the only question we have. So Casey, if you want to go ahead and wrap this up for us.
Again, thank you so much for taking the time to listen to us. We know it's been a extremely volatile period of time here in the market, and we hope that you found these webinars very helpful to get a better perspective and understanding of our thinking and what that's meant to client portfolios. But more specifically, if there's questions that you have about your own circumstances that you'd like to ask, do not hesitate to reach out to us. Again, it's been a challenging time, and more importantly, what does it mean to you? And if we can be of a help to a friend or family member, we'd be honored, and please pass their name along, and we'd be glad to help. Thank you, and have a wonderful day.